This week regulators joined hands to highlight the crypto sector's inherent risk, but pro-traders fought back by adding leverage to their long positions. It's possible that many people have already forgotten that Bitcoin's BTC price closed 2022 at $16,529, and the recent rebound and rejection at the $25,000 level could raise concern among certain investors. Bears are pushing back at the $25,000 level, and there has been multiple failed attempts at the level between February 16 and February 21. Currently, it looks like the $23,500 resistance is continuing to gain strength with every retest. Pinpointing the rationale behind Bitcoin's 45.5% year-to-date gain is not apparent, but part of it comes from the United States Federal Reserve's inability to curb inflation while raising interest rates to its highest level in 15 years. The unintended consequence is higher government debt repayments, and this adds further pressure to the budget deficit. It's virtually impossible to predict when the Fed will change its stance, but as the debt-to-gross domestic product ratio surpasses 128, it should not take longer than 18 months. At some point, the value of the US dollar itself could become endangered due to extreme debt leverage. On February 23, the Fed, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency issued a joint statement encouraging US banks that rely on funding from the crypto sector to prevent liquidity runs by maintaining strong risk management practices. Regulators said the report was spurred by recent events in the industry due to increased volatility risks. Let's look at derivatives metrics to better understand how professional traders are positioned in the current market conditions. Margin markets provide insight into how professional traders are positioned because it allows investors to borrow cryptocurrency to leverage their positions. For example, one can increase exposure by borrowing stablecoins to buy long Bitcoin. On the other hand, Bitcoin borrowers can only bet against short the cryptocurrency. Unlike futures contracts, the balance between margin longs and shorts isn't always matched. The above chart shows that OKX traders' margin lending ratio increased between February 21 and February 23, signaling that professional traders added leverage long positions as Bitcoin price broke below $24,000. One might argue that the excessive demand for bullish margin positioning seems a desperate move after the failed attempt to break the $25,000 resistance on February 21. However, the unusually high stablecoin BTC margin lending ratio tends to normalize after traders deposit additional collateral after a few days. Traders should also analyze options markets to understand whether the recent rally has caused investors to become more risk-averse. The 25% delta skew is a telling sign whenever arbitrage desks and market makers overcharge for upside or downside protection. The indicator compares similar call, buy, and put, sell options and will turn positive when fear is prevalent because the protective put options premium is higher than risk call options. In short, the skew metric will move above 10% if traders fear a Bitcoin price crash. On the other hand, generalized excitement reflects a negative 10% skew. Notice that the 25% delta skew shifted slightly negative since February 18, after option traders became more confident, and the $23,500 support strengthened. A skew reading at -5% denotes a balanced demand between bullish and bearish option instruments. Derivatives data paints an unusual combination of excessive margin demand for longs and a neutral risk assessment from options traders. Yet, there is nothing concerning about it as long as the stablecoin BTC ratio returns to levels below 30 in the coming days. Considering regulators have been applying enormous pressure on the crypto sector, Bitcoin derivatives are holding up nicely. For example, on February 22, the Bank for International Settlements General Manager Augustin Carstens emphasized the need for regulation and risk management in the crypto space. The limited impact of the BIS statement on the price is a bullish sign, and it possibly increases the odds of Bitcoin price breaking above $25,000 in the short term. This article does not contain investment advice or recommendations. Every investment and trading move involves risk, and readers should conduct their own research when making a decision. The views, thoughts and opinions expressed here are the authors alone and do not necessarily reflect or represent the views and opinions of Cointelegraph.